Welcome to the Brew. It's Thursday. That means Traders Workshop. The lads are here with me. Today we are going to talk about Meta Matters, insights and strategies from their earnings call last night. So let's have a look after the bell. Unbelievable. By the way, we have some new kind of rights music coming, so it's going to get better. It's going to be sort of a Lex themed playlist.
Can't wait to see what that sounds like. Can't wait to hear what that sounds like.
Oh, good Lord.
What decade will it be from?
It's probably from a decade you weren't even born in, I'm guessing. 80s or something like that. Who knows?
Oh, I was born in the 80s.
Oh, okay.
We can do with some good 80s around here.
Yeah, that's some good.
Come on.
I know.
Holiday.
Yeah. We're going to have the Bangles.
Yeah.
All right. Meta. Today's topic, Meta, the Facebook guys, the Facebook peoples. Do you guys look at this earnings stuff? You know what happened here? It looks like it was a blowout, right?
We're up like $50 now?
Yeah, up 45, about 8.6%. Coming from, I guess they really surpassed estimates. So 5.16 EPS for this quarter. Estimate was 4.70, so that's a hell of a beat. Revenue was approximately for the quarter 39 billion, which beat by about 760 million for the quarter. But hey, what's 760 million among friends? That's a 22% year-over-year increase in revenue, which is monster. What's your guess on where it's coming from? Any guess where they made the money?
So they spent a lot on AI, but I think it was ad revenue, right? Ad revenue made a ton of money.
So their core advertising business, along with engagement with other platforms, Facebook, Instagram, all that kind of stuff. But you're right, AI was a big deal. So they've spent heavily and invested in the AI metaverse and positioned themselves for some future growth. So, good story. Mark Zuckerberg just got a lot richer. Really cool. So,
yeah, but it's still not at the highs, right? Like, I mean, it tanked not long ago.
It feels like it's at the highs. I know it isn't. I'm gonna look in a second. I'm pulling this up now. It feels like it's way up there, but it probably isn't. So let me get in here while we're talking. All right. So the best question here, or not the best question, but a question is, how do you trade this stuff? As a retail trader, let's say, the pro days, Mark, you and I can nibble on that a little bit in a second. But as a retail person, what kind of strategies are available? I know every strategy is available. What kind of good strategies should they be thinking about, do you think?
Well, you've been given all these revenue, earnings. I don't even know what any of these numbers mean. My only question is, what was the straddle?
Yeah, that's a great starting point.
Throwing around a bunch of nonsense and monopoly money numbers. What was the straddle?
That's a great question.
What was the straddle? How much did it move?
Yeah, no. So here's what it was. Okay, hold on. I'm trying to get days up here. Give me a second. That's a great question because that's how I think about it. So the straddle yesterday and the earliest expiration was, let's call it $40 roughly. Okay, it could have been 39. It could have been 41. I don't remember. I know it was about 40 because that's the number I used. So it was a $40 number. The stock is 45. Again, close enough. I always liken it to dropping grenades. Just kind of lob one in there and get sort of close with your strategy. And in options, you'll probably be just fine, right? So having that arsenal behind you, and I will tell you that implied volatility in month 0, that's the one expiring, was about, I want to say 150. Again, give or take 15 volatility points. It might have been 130 something. Next month was 71. Okay. So I'm giving you all the details, Mark. We're going to come up with a refined strategy. I did one actually in real life. And I took it off this morning. I probably babied it and got out too early because I'm a big baby and I can't take it. I go, I got a profit. I want it. I really want it. So anyway, I took it.
I think the first thing I would say, though, before we get into this is I would I would stay away from just flat equities when playing earnings. You know, like a
Meaning,
Delta One,
yeah.
like buying Meta stock or selling Meta stock.
Perfect.
And
Love it.
the reason why is because you don't know what's going to happen. And unless you're like, you know, you would have to be quicker than the algorithm in order to, you know,
100%.
to do any sort of risk management on it. So, you know, really options to me are the only way to play, any kind of earnings. And from that too, you kind of have to be well versed in your option strategies.
Mhm.
You know, just flat, you know, long call, long put, while it has fixed risk, so it's a little bit better. You still need to be well versed in implied volatility, kind of like what Mark is saying. What is the straddle cost? You know, like you have to determine what the move is before, you know, what the move is predicted to be.
Yep.
Before you make any kind of move.
Okay, good. You're singing my song. Okay, I love it already. Mark, let me let you comment first before we go into some of the things that happened here.
So I'll say that, full disclosure, I hate trading earnings. I think they are a crapshoot. I think it is throwing darts at like a pool of emotions.
What fun are you? You're no fun.
And I think it is a waste of most people's time. But I think that there are very reasonable things you can do with options if you are long the equity already, like protecting yourself getting into an earnings. Like, I think that's a reasonable play. So maybe I'll answer from the dealer side of things, because I think earnings, and the reason I specifically use the emotions word is because earnings are very context dependent. That, like, would Meta be up $55 today or $45, whatever it's ticking around at right now?
Yep.
If we hadn't gotten the FOMC that we got yesterday, would we have that kind of move if we were in a 30 VIX environment rather than a 15 VIX environment? That, like, no matter what those numbers say, and obviously corporate, you know, return or results are, you know, correlated to VIX levels and how the economy is doing overall, but like, earnings are such a context dependent news release. And so I think that's like one of the important things to keep in mind about it is, what's the market thinking we're going to do? And like, what is the market environment that we're in overall? What are the flows saying? Where's vol? You know, what's the story?
Yeah. I gotcha. So you are not a big fan of the earnings play. And I agree with you. As a market maker, I hated them too when I was on the floor. Hated them. Because inevitably I'd get into a position that I just, you know, a lot of risk on a big move. I already knew it was going to move big either way. And I had to make sure I sold enough volatility to cover that move for the most part. Because I was always selling things, right? We were always selling things, at least as DPMs. So that was always a little bit problematic. Jason, sorry, I didn't want to interrupt you. Were you going to say something? You got another thought here?
I mean, I'll take it from the retail side. I think earnings are fun, but you know, I kind of also agree they're not an investment strategy.
Right.
Personally, you know, in my Discord, we obviously use Voland because a lot of times earnings plays gravitate toward Vanna strikes.
Yep.
Large Vanna strikes. So as they did in this scenario as well.
Yep.
And, you know, we also use the straddle costs and stuff. We also use ORATs, the website of, Ding, website of our mutual friend, Matt Amberson.
Yes, love that.
He has a really good earnings. He has a really good earnings page where he shows the history of earnings moves, the fundamental, like the balance sheet fundamentals, all that kind of stuff, the earnings per share, all that, you know, and so he shows a lot of the history and the prior movements compared to the expected movements. So I like using that site combined with Voland to determine, you know, which way it will go. Now, obviously, earnings is a more of a fundamental player, as Mark said, a context dependent play. Because even like Microsoft beat earnings and it like got crushed. You know, it's you know, they were concerned about cloud earnings or something like that. Well, who's concerned about cloud earnings? Like, I don't. Is it this guy, but not this guy? Is everybody get together and they say, today these earnings, we're going to decide cloud earnings are going to be what's the market. So I mean, and a lot of times too, when you read about earnings reports, they're very retroactive. Like you go on CNBC right now and you see, oh, Meta's up because its earnings were great. But if Meta was down, they would figure out a reason to say Meta is down because, you know, they spent a lot on AI or something.
They're committing to spend $19 billion a quarter in the future or whatever.
Right. So like anytime you read about earnings, it's a retroactive kind of thing.
Right. Okay. Good.
So that's kind of, so earnings for me is solely a flow kind of play.
Okay.
And then, you know, and you use options as your tool, not the equity itself.
100% agree. Okay. So far, so good. We're getting somewhere. So here, I'm going to tell you my strategy on earnings. And you guys tell me how stupid I am. Ready?
All right. That's easy.
Okay.
Lex,
I know.
stupid.
I know. My wife tells me all the time. So I don't know which direction to bet on. I hate using the word bet, but to structure my position on. So what I tend to do is I do double calendars. Okay. Stay with me. So that means for the folks watching that I'm going to have a call calendar spread and a put calendar spread because I don't know which way it's going. And I'm going to place those around where the stock closes roughly the night before. Why am I doing that? And we're going to share the screen here in a second. Let me share it now. Okay. Why we do that?
Double calendar or is it a straddle swap?
It's a, I don't know. You tell me. It's a double calendar. I'm selling front month, buying second month. I could be a double straddle swap. It's, let me think about that. I guess it could be.
Isn't it two straddles? You're selling one and buying the other. That's two calendars.
Well, it's two strangles.
Okay, but yeah, fair.
Oh, you could call it that. That's safe. But look what I did here. And we got to use our imagination because the stock's already open and changed, right? So last night the stock closed at 470. Let's call it 475, right? So can you see my cursor?
Mm-hmm.
Okay, 475. So that was my starting point last night. The straddle, to Mark's point, was about $35-ish. Okay, so 475 plus 35 is around 510. I always like to get a little more juice, so I went to the 512.5 strike. I sold the 512 in the high volatility month, which is this August 2nd with 1 day to go. It's the front month. And I bought the 512 in the next month. So I had a volatility difference of roughly, from memory, 50, 60 points. Okay. I did the same thing to the put side. I used the same mechanics. I took 575 minus about 35. I somehow got to the 500 strike. I'm sorry, to the 432 strike, right? So you can see that I still have that on. Now it didn't go down. It didn't go down. It went up. So I'm covering both angles. And why do we use the straddle? It's a fairly good approximation of what a one standard deviation move, at least with the market makers thinking that move could be. Okay. It's not exactly perfect. There's a higher level of mathematics that'll get you there. Again, let's drop the grenade and get close. That's all we're hoping for here. Okay. So my put spread obviously lost, right? But look where my call is. That's where my call is, this little red line here. I'm above the strike by a little bit, but look what happened to this thing. So let's try to look. This is the portfolio page. I've broken both of these out. Calendar for the call, calendar for the put. So I did this as a four-way package. I bought all four together as one unit. If you add 195 plus 140, you get 335. That's what I paid for this whole package. $3.35. That's my biggest, that's my risk, right?
Mm-hmm.
When it opened, my belief is that one's going to be really bad. So the put spread part of this went to 16 cents from 140. I lost that amount of money. However, the call spread expanded. Now the call spread can expand even further, which it has already. I've already messed this up a little bit, but look where the call spread is. It went to 482. So the sum of these two things, let's call it 490 for argument versus 334. We make a buck and change on this whole deal. Now I don't take the put spread off just in case something comes out intraday, and I got 2 days because this doesn't expire today, expires tomorrow. Something happens where, oh, you know what, these earnings weren't as good, or I forgot to tell you about this, and it goes back down to the put. Now I can double whammy it. I already got money in the bank. Win. Big winner now. So what do you guys think about this play? I know a lot of my cronies from market making business make this play a lot. And you could argue about standard deviation. Should you give yourself a little bit more cushion, which I agree with. That's probably fine. But you want this stock to open near one of your short strikes. And that's where you kill it. Where you get hurt. Go ahead. Sorry.
So here's my opinion on any kind of calendar during earnings plays.
Yep.
Calendars
risk here too. So I'll talk about that in a second, but go ahead.
Well, calendars intrinsically are a positive vega trade.
Correct.
Which means that you're expecting implied vol, or that you're implying that you're expecting volatility to increase, implied volatility to increase when you make this play. So
I'm going to have a counter argument to that, by the way, in a second, but go ahead.
Okay. Well, I mean, there is, like, when you're doing a weeklies and this 1 day versus 6 days, it's a little bit less of a deal. But if meta didn't move, you would be losing money. And that's, you kind of want to be, you kind of have to hit the target pretty closely. Personally, I always kind of prefer the like broken wing butterfly way, or maybe just like butterflies on either side. Mm-hmm. And that way you're taking advantage of the decline in implied volatility.
Okay, not bad. I like it too.
Mm-hmm.
Yep.
Yeah, yep. I mean, that's my personal preference versus the double calendar, but I think this is more effective than, say, like a long gamma vertical or something like that. Right.
So let me just say a couple things, and you being the mathematician are going to know this better. The difference between a 140 volatility and, let's say, what did I say, a 70 volatility, let's say. Well, you can see where mm-hmm. implied volatility is now after the event. It's in the 36 range, right? Mm-hmm. But when I'm selling 140 vol in the front month and buying 70 vol in the second month, mathematically, it's not the average of the two. It's some other number. There's mm-hmm. a mathematical formula that tells you that you may be actually buying Vega that's less than 70 because of the difference between the two terms. Okay. Mm-hmm. And we'll spell that out. I'll draw that equation out next time. I don't have it handy. But we used to use that, and what it is we called it adjusted Vega. So mm-hmm. just for the folks, it's not a simple add together and divide by 2. It's some other number that actually gets lower than the 70 vol in the second month. Okay, so your Vega, though you're long, is a number that's less than 70, and I don't know what it is exactly. I'm going to guess it's in the 50s, but because mm-hmm. of the revaluing and the massive revalue, that front month from 140 down to, right now 56, that's where I make my money. What I've noticed about these things is that I do these a lot. And yes, you need a move. Even if I don't get a move, I don't lose a lot. You know what I mean? We'll get a revaluation and I might be down 20, 30 cents. You as a trader have to make a decision. Did you miss it? Are you done? Are you taking your 20 or 30 cent loss and getting out? That's a different conversation, right? But every one of these, even the ones I miss by a little bit in terms of a distance from the short strike, I still end up wiggling out of it for a profit. Now, I got out too early. I left 50 cents on the table here. But, I'm a big fan of let the numbers play where they play in the first half hour. And then when things settle in a little bit, you start getting consolidation. That's when I like to get out. Mm-hmm. So, Mark, any comments on all this craziness? You can say no.
I think you've got better odds and free drinks if you play blackjack.
This is one of my favorite plays because I got so much in my favor. I love this. So, look at, again, if it blows through the strike on a 2 standard deviation move, you're not playing for that. I'm playing for the 1 SD move. Even that's my biggest risk is if it shatters my short strikes by, $20, $30. Right? There's still premium in the put or in the call, as the case may be. So I'm still going to have some value in that trade. Now I'm going to lose, granted, but I'm not going to lose a lot. For me, it's a very low risk, low reward strategy that tends to pay itself a lot. I've done these in the big earnings all the way through, and I don't think I've lost once yet. So I like them, call it what it is. Mark would rather play blackjack, but I love this trade.
I think on the big earnings, I think you have a better shot at the 1 standard deviation move. I think that's but if you have like illiquid equities and illiquid options on them, I think that's a little bit more dicey.
Yep.
But so in that sense, let's put on an Apple trade.
Is that coming out? When is that?
Tonight. Friday, August 2nd, I think.
Well, I thought it was tonight.
Well, gosh darn, let's call it up.
Maybe it is tonight.
Tell me a story, Gaddy. Tell me a story, and I'll pull up Apple while we're talking about it.
I will say that using the straddle, I think the straddle is by far, I call it the hammer. Like of all the things, if you have one tool in options trading, it's the straddle and knowing where to price
100%.
want to sell puts on the downside, find your straddle range and sell outside of that for your cash.
I love it.
You want to set up your like wings or your levels on your earnings trade. Straddle's great. Like I haven't refreshed it over the last cycle, but like historically, the last couple of quarters, we've been really nailing a lot of those straddle price moves. That like the straddle doesn't pay because it moves just about to that straddle, and you lose a little bit about it, which is a perfect win for Lex's strategy, right? Like it's a perfect win for that strangle swap that you do. So, you know,
I like the strangle swap. That's really fancy.
You add swap to the end of anything, and it just sounds a little more elevated.
Yeah, I agree with that. I agree with that. Okay, so stay with me here. I'm putting on. Okay, here we go. Are you ready for this?
Mm-hmm.
This is a bonus. This is a bonus because you told me Apple's earnings are tonight.
Yeah, they are.
Okay, hang on. All right, here we go. Let's go back to the screen. All right, so here's Apple. Let's have a look at this the way I see it. Okay, and you guys tell me I'm dumb again. Here's the straddle 22.5. Right. You add these. I always take midpoints, but I just try to get close. Again, this is about $9. Let's call it $9. Safe enough, right? The straddle, $470 plus, $430, $9. Good. $9 up. Again, I'm not getting close. I want an extra room. I went up $10. 232, 105, 107 on the call, down to 212.5, 113, 117 on the put. I like the numbers to be about the same premium. That also is very nice to see. Okay, going to go out to my second month. Notice 86, almost 87 implied volatility versus a 40. Okay, so the second month I chose the same strikes. We get a value of, or not a value, but we get a price of 145, let's call it. Right? If you look at this in the risk analyzer, look at this risk graph. I got a lot of place in this thing. Right? This is my little, I always call it a circus tent. So I got, down at the short strikes are my biggest profitabilities. Way up here. If a blowout, I lose. We already said that. Way down here on a crush, I lose. Right, but I got a lot.
Do you have
some money? Go ahead.
But you have the what if up. You got a what if the implied vol's down.
Correct. It's even better. Right, it gets even better. So you could do that too by using this calculator thing. So we got 146 here. If you can see that, I think you can. Good. Let's see what happens. Now you gotta make some guesstimates. What generally happens is this comes down, this stays a little elevated. So what I like to do is I like to bring these all down to about the same. And I always, go down to some value that I've already studied. So remember it was 146. So just remember that number because it's all going to change here in a second. So let's go down to 35. I think that's probably a little low, but we'll see what happens here. Okay. So look what happens. Look at my number up in the top there. Okay. This should get. Okay, so I'm already at 251 at 35 volatility across the board at this price, right, in Apple. Now, if I go down to where I think it could go, I'd say 213 again, about what I estimated. Get to 289 on the spread. If I go up to, what was the other number here? 232. Let's see what that does, right? 330. So I got $1.40. This is all theoretical. I can make 330. 289 on the downside, $3. Again, big blowouts, you're going to lose that 146. Not all of it. You're probably going to get out for, 50 cents, 70 cents, and you're going to lose $1. Okay, but I like my odds here. This is one I would love to do. And you know what? Do I do it now? I probably say no, not yet. I'm going to let the day settle, and I'm probably going to put this on later in the day. I don't think implied volatility is coming down anytime soon, right? So I'm going to Whoa, Jake.
Let's execute it.
Whoa. Look at that. So I'm going to let that one play this is one I'm going to do today for sure. Now, the numbers might be different as the day wears on. I'm going to put this on about 2:30, which is a half hour before closing in Central Time. Okay. And Mark hates this trade. I can tell. Mark is like, give me a glass of wine and put me at the blackjack table, and I feel like I can do better.
Yeah. I'm just going to head down my equity around earnings and go drink wine. I'm not making plays.
Oh, I love this. I love earnings because I love this setup.
You're not able to share my screen right now?
You can if you want. You just have to do it.
Okay, let me hit the button because I'll give some more context.
I hope this is the Volin take on this. Is there any? I was going to ask.
Actually, we're going to do Volin and or Rats.
Okay, so let's look at that relative to Gamma, Vega, Vana, or any other metric that you find useful. Anything you can add to this is helpful, right?
Okay. Well, first we'll look at Vanna because I have this here. It looks like from Apple's standpoint, oh, this is just puts. Hold on.
Do them both.
Okay, so there seems to be a let me go to puts and calls. All right, so here in Vanna, it looks like the downside could be if Apple comes out with really bad earnings, the downside could be treacherous, but the default is a slight move up, probably like 10 points. It's actually that's pretty accurate. The way the straddle is priced.
Isn't that something? Those market makers are smart. I'm telling you.
Yeah, they know what they're doing or something. Probably about 10 to 15 points, 20 points maybe max.
Okay.
Like right here, that'd probably be like the default area if once this is done.
Okay.
But if earnings are bad, it won't stop. Looking at ORATs here, we see that it looks like it actually most of the time pins to the expected move. Like, look at this.
Crazy,
there seems to be, it's pretty close.
Mark, are you feeling better about this yet, Mark?
Perform a little bit.
I mean,
you're talking me into it.
The markets are that the more people are trading, the more liquid, the more efficient the markets are going to be.
Correct.
Prices are fair. So that says there's no move to make. That means you just exchange your risk where it's relevant.
Yeah, you could also look here that it looks like so this is kind of typical from what we've noticed is upward revisions on most stocks equal upside. It looks like it had 8 upward revisions here, pinned to the top of the expected move, 7 upward, exceeded, 5 and 7, exceeded, tanked. So it looks like most of the time, and we have upward 9 here. So I would say that your move is probably pretty good, but you might want to think about leaning a little bit into the maybe do like 5 on the upside, 4 on the downside kind of thing.
So that's what I'm looking for actually. So that's the kind of data that makes it better, because if I can peel one side off or mitigate one side, then I feel better about it. But I don't have that ability, and I'll openly admit to anyone, I am not a good directional trader. That's why I do doubles, because I have no idea. But if I do 2 to 1
or something like that,
yeah, exactly. You can do 2 to 1, 100%. Love it. Mark's still not playing. He's out. He's like crying over there. He's like taking his bat and ball and going home almost.
No, see, I'll tell you what I think. What I like to do into earnings.
All right, go. I love to hear.
Only if you have a position already in something, you're long Apple stock, you're long Meta, you're long one of these. Like, there's an argument that you should use the options pricing to hedge out some of the risk, right? Earnings are very conditional. They're very scenario based, right? Like we have a bad FOMC and the right mix of language or wrong mix of language causes Apple or Meta or whoever to tank on this. I think this is a perfect case for a short-term put spread collar. So while I like doing something like that normally at the 90-day level or whatnot for longer term investments, that into earnings, that's an argument for doing this at the week or month level, maybe a little bit out. But take advantage of that high vol and exchange one convexity for another. If you're long this equity in the first place and you want to continue to be long, you obviously believe there's some potential upside to it, keep your upside. You could have done a put spread collar in Meta yesterday, gotten up to 7% upside and buffered the 20% downside. So you lose the left tail and you still get up to roughly the straddle in gains. That seems like a pretty good trade-off to me.
Yeah. Okay. In this scenario with Volin showing that the downside has doesn't have much support at all for Apple, I would maybe not if I were to do that kind of strategy, I would maybe not do a put spread, just a put or something like that. Maybe a put further south or something like that.
Yeah. Is it safe to say that we're not big fans of buying that straddle in that front month because the vol's so high, even though they price it pretty well? But you're not making any money on that technically, right?
Right. Just because they price it well doesn't make it a good trade. I mean,
I like
you have a chance to lose money and a little bit of chance to lose a little bit of money.
It doesn't make it a good trade, but it makes it a good market. And the point of coming to the market is not to have arbitrage profits. It's to have a risk that is priced efficiently that you can exchange for some other risk.
And that's why I love that straddle price. I use it a lot, and I always give myself a little room, always. So again, lob a couple grenades, get close, but give yourself a little room. What about the iron condor, which is a famous play for the retail folks? So using that straddle, peeling it out a little bit more. Good play, bad play. Again, defined risk. What do you think? That way you don't have to take any Vega risk at all.
I don't like the return to risk on earnings for that.
Okay.
That's just my personal opinion, because sure, you may get that like middle, if Apple doesn't move at all, you get that middle, thing there. But volatility has been high recently. It's been higher than implieds have been for 30 days ago. And I think that especially a lot of these tech earnings, they can tend to be pretty volatile. I would try to keep my risk down as much as possible and definitely keep my return to risk up. So I'm not a big fan of the Condor unless you kind of have an inkling that, if I looked at ORATs and saw that dot in the middle of every single thing, then maybe a Condor would be good. But when you see it pushing the edge, I'm not into the Condor.
Okay.
It's hard enough to be short ball in individual equities, and to be short that like idiosyncrasy on a known news event is like picking the worst possible time for it.
Right.
No matter how much more you're getting paid for it.
Yeah.
Right.
Fair enough. That's why I like this play. So right now, just so we're clear, I will have an update next week, because we do this on Thursdays, on the Apple play. I will have this Apple play on by the end of the day.
You might have to talk me into it, Lex.
I have to stress to folks, if you're going to do this, give yourself some time till the end of the day so you know where that straddle is going to settle, right? Because the stock's going to be up and down and all over the place today, and let it settle toward 2:30 Central Time or 3:30 Eastern before you start making your play. Okay. Cool. And Mark's still pouting, and he's going to have a glass of some really fancy Aix-en-Provence rosé later.
My recommendation now on rosés are Tavel.
Tavel.
Yeah, nice dark rosé.
How do you spell that?
Tavel.
Easy enough. I think I know that one, actually.
It's on the banks opposite Chateauneuf-du-Pape. And originally they made red wine, but now they are only allowed to make rosé. So it's a very dark rosé.
Love it. I'm gonna. Can I get that at the Binnies in Chicago?
Oh, yeah. Chateau d'Acura, very well distributed.
So I go to the south of France section, correct?
Correct.
Yeah.
Or the rosé section, however your local merchant is.
And you and I were just there fairly recently in the south of France. One of my favorite places. Yeah.
Yes, it is.
You know what? In order to pay for that, I've got to do these calendar spreads like size. Like,
how many calendars are you doing to pay for that?
I mean, the one lot's not going to make it, man. We got to get 100 on the table.
Yeah, that'll pay for a trip to the south of France.
Oh, yeah. All right. We don't have the assets yet to close this show up, because I want to show Jason and his mug on a sort of an adeum/vol.land kind of graphic. So I know we're working on that. And Mark, harvestedfinancial.com. I want to show his mug on that too, and then do a multi thing. It's coming. Don't worry, next time, and we'll have the close relative to that. We're going to be so dapper.
People are going to tune in just to see this graphic.
I think so. Don't forget hub.tradier.com. Leave us some comments. Tell us what you want to hear about. These guys are really good about this stuff. And we didn't agree on something today. So I like the debate. This is fun. But know that I'll have that spread. Right now, that Apple spread's trading $1.40. I'm just looking at it on a corner of my eye.
All right. I can put this on.
All right.
I'm pulling out my Trade Hawk.
Don't do it. Don't do it yet. You got to wait till 2:30, Mark. I'll give you
to the end of the day, apparently.
Wait till 8:30?
2:30, yeah. No, well, you're on the East Coast, right?
Oh, yeah.
3:30 for us.
Don't miss it.
I'll be out to lunch.
I'll be out to lunch. All right, boys. Have a great weekend. Good to see you as always. Good conversation. That's a wrap.
Happy trading.
Happy trading.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.